Hey everyone, welcome back. Today we are hitting day 4 of the Crypto Trader curriculum for this explainer, and our entire focus today is on demystifying candlestick charts. To really understand market dynamics, you absolutely have to know how to read the visual data. So let's get right into it.
Okay, let's dive into this. Have you ever looked at a crypto chart and just felt like you were trying to read a foreign language? Honestly, even if you follow the markets pretty closely, pulling up a brand new chart can sometimes feel like staring at this chaotic sea of green and red bars just flashing and bouncing all over the place. It's a massive, massive volume of visual information. But today, we're going to take all that raw visual data and translate it into a really clear, readable story.
So here is our roadmap for today. First, we'll look at the anatomy of a candlestick. Second, bullish versus bearish battles. Third, the lens of time frames. And finally, spotting market patterns.
All right, kicking things off with Section 1, Anatomy of a Candlestick, the fundamental DNA of trading.
So, the crucial point is understanding the 4 atomic data points that make up every single one of these charts. In the trading world, we refer to this as OHLC. It's just a simple acronym that stands for open, high, low, and close. These are the 4 specific prices of an asset over any given period of time. The open is literally the price the asset traded at the very first second of that time frame. The close is the price it traded at the very last second. And, during that time, the price likely fluctuated, right? So that establishes a maximum peak, which is your high, and an absolute bottom, your low. Every single candlestick you see is basically just a visual container for these 4 pieces of OHLC data. Now, a chart isn't just some random mathematical output. Actually, scratch that. It's more like a historical footprint left behind by market traders. When we take that OHLC data and draw it out, it creates the physical anatomy of the candle, which has 2 main parts, the wicks and the bodies. Think about that footprint analogy. The thick, solid part of the candlestick, that's the body. It represents the space between the open and the close. This shows you exactly where traders actually stood their ground and established value during that time. Then you have these thin lines sticking out of the top and bottom of the body. These are the wicks. Wicks represent the high and the low. They show you where traders briefly stepped, kind of exploring higher or lower prices before retreating and settling back into the body. Basically, the body is the substance, the wick is the exploration.
Moving right along to Section 2, Bullish versus Bearish Battles, the ultimate tug of war.
Market sentiment is essentially an ongoing battle. I know. Bullish and bearish might sound like we're watching a nature documentary, but these are pretty much the only 2 moods a crypto trader actually has. Bulls thrust their horns upward, meaning they buy. Bears swipe their paws downward, they sell. And this brilliantly illustrates exactly how we determine who won that tug of war for any given period. A bullish candle means the open price was lower than the close price. The buyers took control, they pushed the price up, and they held their ground by the end of the period. Conversely, a bearish candle means the open price was higher than the close price. The sellers completely overpowered the buyers, driving the asset's value down by the time the clock ran out. By simply looking at whether the candle closed higher or lower than it opened, you instantly know which side of the market is currently calling the shots.
Which brings us to Section 3, the lens of time frames, zooming in and out.
Up to this point, we've been talking about a candlestick as representing a specific period of time. But changing your time frame completely changes the market narrative. An incredibly chaotic, volatile minute where bulls and bears are violently clashing can look like a perfectly calm, flat day when you simply zoom out. Now, what's really interesting about this slide is the comparison. A 1-minute interval reveals the microscopic heartbeat of the market, which is perfect if you're a day trader looking for immediate, rapid moves. But if you switch to a 1-hour or a 1-day interval, each candle is now absorbing and condensing massive amounts of data. To put that into perspective, a single 1-day candle literally contains 1,440 1-minute candles. The time frame you choose acts as a lens, filtering out all that extra noise to align the chart with your specific trading strategy.
And finally, Section 4, Spotting Market Patterns, where we start reading the clues. Now that you understand the individual candles, it is time to put on your detective hat. You aren't just looking at abstract shapes anymore. You are now fully equipped to read the visual clues that millions of traders leave behind. Once you master reading individual bodies and wicks, you can begin looking for larger, recurring patterns on historical charts. Individual footprints form a path, right? And by recognizing how these paths have formed in the past, you can realistically gauge where the market might logically go next. A sequence of specific candles tells a much richer, much more complex story than a single candle ever could in isolation.
Let's move to and see how this builds into a practical exercise. Whenever you open up a historical chart, just walk yourself through these 3 steps. Step 1, look at the body size. Is it a massive body indicating really strong momentum, or is it a tiny body showing indecision? Step 2, check the wick length. Are there incredibly long wicks? Because that shows one side tried to push the price but got aggressively rejected by the other side. And step 3, identify the major formation. Look at how the current candle interacts with the 2 or 3 candles right before it to see if a recognizable repeating pattern is emerging. By systematically checking the body, the wick, and the broader formation, you completely strip away the emotion, and you're relying strictly on the data.
Think about it. You've just unlocked the fundamental DNA of trading. You know how to decode the open, high, low, and close. You know how to spot the battles between the bulls and the bears, adjust your lens with time frames, and hunt for recurring patterns. The chaos, it's been replaced with clarity. So I'll leave you with this one final thought. Now that you know the language, what story are the charts telling you today? Get out there, open up your charts, apply this new visual literacy, and start reading the market for yourself.